the market has tripled in size in terms of number of insurers and capacity out there.
Covered 4 risks, and there are probably many more that we can talk about.
But for the businesses that happen to be in those areas, they could very easily be distracted by these other big global events.
Heightened risk, geopolitical uncertainty, and now what many term grey rhino events are becoming the norm. For business leaders, being able to navigate this risk is crucial for success. At the midst of banks and traders navigating the Gulf conflict, fluctuating oil prices, inflation risk, and geopolitics, I'm joined by Marsh Credit Specialties experts John Plomer and Chris Koperk to help navigate through some of these. John, Chris, welcome to TTP Studios.
Thank you very much.
Glad to
Thank you
be
for having
here.
us.
So, John, first of all, quick introduction. Can you give us an overview of what you do at Marsh?
Sure. So my name's John Plomer. I've been at Marsh for about 20 years this year. I work in credit specialties and I focus on broking for primarily financial institution clients, so helping them access capacity in the market. But I've also worked with plenty of other client types like export credit agencies, defense contractors, telecoms companies, all sorts.
Thank you very much. And Chris, over to you.
So whereas John works on the broking side, I work on the sort of analytics and client support side. I lead what's called our geopolitical and economic risk analysis team. And so this team has been around for nearly 30 years. I've been around for 3 in this particular position. And we basically work on, for clients that are operating in these challenging environments, these unpredictable environments, providing some context, some perspective, some insight, some data as well to help them have a better, more holistic perspective on what the risks are and what challenges they might be facing as they're going about making their insurance and risk mitigation decisions.
So thank you very much. And now to start this interview, we're actually going to do something a bit different. We're going to shake things up. So here's a wheel of risk that we prepared earlier. So as you can see, there are 12 different risks. There are actually 4 different risks multiplied by 3. We've got regulations, uneven regulations. We've got non-payment insurance, trade policy, and dealing with conflict. So we are going to quite literally spin the wheel, and hopefully you gents can give us an overview of what's going on. How does that sound? Do you agree to play the wheel of risk?
Spin away.
Yeah.
Here we go. Okay, so first of all, we have uneven regulation or regulatory divergence. And Chris, perhaps I'll start with you. How much is regulatory divergence now shaping how and where capital is deployed, particularly as Basel implementation is becoming increasingly varied in terms of its implementation around the world?
Yeah, so if you look at in the UK or Europe or the United States or Asia, you're all going to see sort of different levels of regulatory implementation of what is really the same thing, but also confusingly has about 5 different names, whether it's Basel Endgame or Basel 3.1 or Basel 4 or Basel 3.1 Endgame. Differing implementation levels of implementation around the world. That means who can lend and to whom and at what rates differs depending on what jurisdiction you're in, both because of Basel and other regulatory constraints. And I think this process of regulatory divergence around the world is something that certainly is front and center and focused on by banks and financial institutions because they deal with it every single day, day in and day out. But for people who are borrowing, it is probably not something that is so central to their focus, and they don't understand so well how the divergence in regulations shapes their strategies for borrowing and accessing capital and deploying it and so forth. And I think one of the things we write about in this risk report that you mentioned is sort of broadly this theme of an accelerating geopolitical transition. And when it comes to financial regulations and banks, what's unlikely in 2026 is this sort of broad geopolitical transition is probably not going to have a really significant impact on lending, borrowing, and so forth. But this process of sort of steady disintegration, steady focus on national priorities rather than sort of the broad and difficult process of multilateral regulations that are broadly stronger than sort of individual or sort of like groups of nations creating their own regulatory frameworks, is something that is a symptom of this process of transition that is, in our view, going to continue to play out and continue to diverge rather than sort of come back together on a sort of broadly global set of regulations.
And I presume, John, moving over to you, that makes it difficult for your financial institution clients. What are they seeing in terms of cost of capital and access to financing?
I think the fundamental shift. So, I mean, Basel 4, 3.1, whatever we're calling it, has obviously been on the horizon for quite some time. And so the positives are that banks have had time to think about it, time to adapt their models, a time to sort of to get ready for the implementation process. Does it raise cost of capital? I mean, yes, to an extent. I mean, I think the knock-on effect again is more, certainly in terms of what we do, the impact of how banks use the insurance market. That shifts just in terms of the efficacy of the product and where it fits best and how it's best utilized. But I think, yes, I mean, one of the main points I think that's relevant is it's more about it erodes flexibility in the sense of, at the moment, the banks are looking pretty healthy, but if things were to start shifting a little bit, then that's when you're more likely, I think, to see a kind of contracting in lending and business that's typically historically would have been low capital consuming and low risk becomes less economically viable. And that's when you're sort of looking at potentially seeing some real shifts in appetite, which would then knock on to borrowers having a harder time getting access to funding.
And I guess talking of those, moving away from those typical lenders, Chris, question to you: as a result of this structural shift, are we seeing credit move to other parts of the market, such as private credit, as that regulation tightens?
Yeah, I mean, yes and no. I think off the top of my head, the private credit market's about 4 times bigger than it was in 2015, now about $2 trillion, which is a big number, and it sounds like a big number, but the public bond market is about $36 trillion. So in the grand scheme of things, private credit so far is not that large. And I think if you listen to, some of the institutions out there like the IMF and the Bank for International Settlements, they have, over the last couple of years, increasingly expressed a concern around, is risky lending moving from banks to what is broadly termed as private credit. And I think the general consensus is, to a certain extent, yes, as a result of these regulatory changes. But then I think that brings out the question of, well, isn't trying to move the risky lending away from the banks that are sort of, the systemically important banks, sort of what the objective of the regulation was in the first place? So is it working? And is allowing this different sort of lender in the form of private credit to function and play the role that it is currently playing the right thing to do? Or did they also pose a risk in their own right that needs to be regulated in some sort? And that is what regulators are grappling with right now. And what, again, going back to the previous question you asked me, I suspect regulators in different parts of the world will find different answers to that question.
Yeah, we eagerly await and look at what's going to happen to that market, but also what that means for the borrowers. So we need to move on. So we'll go on to the next risk. Here we go. Okay, so now on to our next risk, which looks like it's credit non-payment insurance and also the cost of resilience. John, I'll start with you. With rising debt levels and ongoing inflation risks, are markets underestimating the pressure building on credit and also in terms of liquidity?
I think when you look at it in a historical context, obviously we went through the financial crisis, and I think a lot of lessons were learned post that. And touching on what we've just been talking about with Basel IV and the regulations around it, there's background to that. I think no one has a crystal ball, sadly, but certainly inflation is a concern. Current global events not really helping push that in the right direction, and I think if that leads to tightening of monetary policy, then that we can certainly start to see some pressures in the market. Rates going up and borrowers struggling more with sort of debt levels. I think at the moment there aren't too many alarm bells ringing, but it's certainly direction of travel at the moment is not looking massively favourable from an inflation/interest rate perspective, I don't think.
Mm-hmm. And has trade credit insurance moved from I guess a tool that's used ad hoc to actually something that's really embedded in the banks, or are you seeing its uptake used differently in different markets?
Yeah, we see it pretty much consistently utilized and has become embedded in the last sort of 10, 15 years. Again, with our favorite topic of regulation, through the Basel II era where non-payment insurance became an eligible credit risk mitigant, it shifted from being, so what it's always done for clients is it protects against an event of non-payment. So your borrower doesn't pay you back, your insurance policy, all having been properly complied with, will make you whole. That's a sort of constant, and it will always, that's what it does. But through the Basel II era, it became actually on top of that a really useful tool for banks to manage their risk-weighted assets and their capital allocations. And that, in certainly for the European banks, I'd say had become really the main driver in recent years. But Basel IV has shifted that somewhat, just in terms of changing risk weightings and things like that. But so many of the banks had made such big investments and made the credit insurance buying part of their syndication process, part of their risk management process, that we now see a much more heavily embedded strategic use of the product, rather than it just being I'm a little bit concerned about this sort of tall tree exposure here. I'd like to mitigate it in the market. So definitely.
Interesting that it's been driven partly by regulation.
Absolutely.
Yeah.
It transformed the product in terms of its reach, and I'd say since the financial crisis, the market has tripled in size in terms of number of insurers and capacity out there. It's grown tremendously.
So on to the next risk. Okay, so conflict risk. Chris, over to you. How should financial institutions really be navigating conflict risk right now?
Yeah, good and important question. The data out there is not super encouraging. The world has seen twice as many conflicts as in 2005. On average, the conflicts are lasting twice as long. I think that's down to a number of different reasons, but one of them being that just the mechanisms for conflict resolution aren't as effective as they were, 20 odd years ago. And so there are these high profile conflicts, obviously Russia, Ukraine, obviously what's happening in the Gulf right now. Those are conflicts that will, of course, have localized impacts, but also can have and will have and are having much broader global impacts, as John alluded to earlier, and you did as well, on inflation, on energy prices, things like this that affect businesses from Melbourne to London. And that they need to understand, the banks and other financial institutions need to understand and think about what the impacts of those are. But also, because there is so much attention put on these high profile conflicts, a lot of the smaller conflicts that are also happening at a higher frequency and taking more time to resolve, that is also something that, especially when lending to particular businesses that might have longer supply chains and spread across the world, that it's really important for financial institutions to understand those things as well. I mean, one good example that I'll give that I think was really underreported on, certainly here in the West, is the conflict that Thailand and Cambodia engaged in, sort of starting the middle of last year, and that really isn't fully resolved yet. This didn't affect a lot of businesses, but it did certainly, in a significant way, affect several businesses who were situated right in the area where the conflict broke out on sort of the Thai-Cambodian border. that were taking advantage of some of the advanced manufacturing capabilities in Thailand and some of the labor arbitrage and cheaper labor that was available across the border in Cambodia to move parts back and forth and have it really early high up the supply chain activities going on there. There's Chinese companies, Malaysian companies, Japanese companies who had to varyingly shut down operations at their facilities, had to reroute logistics. Some figure I saw was 40% premium in some cases for their new supply chains or how they were moving their goods. And so that's one example of the type of event that will get very little press and again isn't going to affect the world, so to speak. But for the businesses that happen to be in those areas, they could very easily be distracted by these other big global events. But for them, actually, what is going to be most significant and most impactful is going to be these localized disruptions. And so thinking about as we're in a world where there are more conflicts, where there's less constraints on conflicts, where they're harder to resolve when they do get started, it's important for the financial institutions who are lending to think, what are the scenarios that a conflict could develop, even if there's not a particular history of something in this situation, or we think the odds are pretty low because, frankly, the world isn't what it was 20 years ago in terms of security and in terms of conflict resolution, clearly. And so operating under the assumption that what came before is what will be in the future in terms of conflicts and how that can affect the risk, the risks that financial institutions are taking on is something that I think bears spending a decent amount of time thinking about.
And John, the answer might be it's quite nuanced and quite complex, but how are your financial institution, multilateral and export credit agency clients thinking about conflict risk?
It's nuanced, yes. I mean, I think essentially, diversification of exposure is massively important. The world that we've seen a number of crises in the last 15, 20 years, the financial crisis, the Arab Spring, the annexation of Crimea, the global pandemic, all of these all of these events. Many of those clients have adapted their businesses to see their way through these difficult times. Use of not here to massively plug in the insurance market necessarily, but part of the sort of the two-way relationship that our clients have with the insurance market is that it's a source of it can be a source of advice, it can be a source of intelligence, and so that goes both ways. So the insurers learn about what's going on out there, and clients can get a bit of a feel as to if there are any kind of hotspots building and can manage their businesses accordingly. But yeah, I mean, I think diversification and open-eyed risk management are really the way forward.
And sorry if I may, one of the things on this that I think is interesting as well is to a certain extent like the revenge of geography, in the sense of 5-10 years ago you might look at a bank or anyone else might look at a risk in, just use the current situation as an example, a risk in Iraq and a risk in Dubai, and draw no sort of connection between the fact that there is a concentration risk, so to speak, there in terms of exposure to a broader conflict over the Strait of Hormuz and involving Iran, when in reality we now know that there is in fact a link there, and so looking at things in less of a siloed fashion and saying under what circumstances could a conflict or a some other sort of physical disruption, maybe it's climate related, for example, lead to these risks that we're taking that we think aren't really sort of dependent or related to each other, or that could go south at the same time. Actually, they are related and they are connected to this risk, this like bigger risk. I think there's more effort being put into thinking about those exposures than there used to be.
Absolutely.
We must move on. So now on to the final risk. So now on to trade policy, but also trade fragmentation, because I think that's been a theme of probably the last few years. would you say we're now in a structurally higher friction trade environment rather than just this kind of short-term volatility? And Chris, this question's for you, because particularly tariff levels, they're at the highest they've ever been in decades. Trade policies becoming a lot more interventionist. What are your thoughts on that?
Yeah, I think, I mean, in the report we wrote, higher friction is the term we settled on. We think there's more complexity for businesses and financial institutions to have to deal with. There's, of course, more regulations, which means a higher compliance burden. There's some research that was done by the US Federal Reserve late last year that said just for the US manufacturing sector, the additional compliance burden of more complex trade regulations and tariff schedules that they were having to deal with was going to cost the sector somewhere between $40 and $70 billion a year. So this is consequential amounts of extra effort that's being put into this because of how politics has shifted towards being more focused on national security and relative balances of power and wanting to protect certain sectors and so on and so forth. And in our view, that's not something that is going to revert back to the previous sort of government serving mainly as facilitators of global growth and global economic activity. Our view is that they will stay more as shapers of this. And that, of course, will vary depending on who the political leaders are in a given time in different parts of the world. But that broader trend is something that we expect to be sustained. So for businesses and for banks, our recommendation would be operate under that assumption that it is going to be sustained and that this isn't a sort of 5, 6, 7 year period of sort of unusual political intervention and economic activity. It's if anything's a bit more like a reversion to the norm.
Thank you very much. Well, Chris and John, we've covered 4 risks, and there are probably many more that we can talk about, and they are available to download in the Marsh risk report. So we've covered, conflict, trade policy, uneven regulations, and non-payment insurance. So thank you very much, John and Chris, for joining us in TTP Studios. It's been a pleasure.
Thank you for having us. It's been great.
Thank you.